I want to start by asking about the new framework. We know what it is. Appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. But what does that mean to you? How do you define moderately above, and how long is some time?
Well, first of all, Mike, thank you for having me on Bloomberg this morning. It's really good to be here. I don't talk to you often enough. But in terms of your question, what I would say is, for me, one of the challenges that we've had historically is that when unemployment or when the employment level has gotten too low, there's been a concern among economists and policymakers that that would trigger inflation that wouldn't be able to be controlled. And so the action typically has been that we're going to try to stop that labor market from overheating, and then in turn that can put a damper on inflation. What we saw over the last 10 years or so is that we could get employment to a very high level without seeing that inflation, and so we wanted to be very clear in the longer run goal statement that we're going to wait to see for evidence of that overheating before we start to take action. And I think that's the biggest, the message to come out of that statement.
Well, what is the evidence that you would look for? Is there a level of inflation above 2% that is kind of your ceiling?
So for me, I would say I'm comfortable being above 2%, and it's actually more the trajectory than the levels. So if we were at 2.2 or 2.3 and it looked like we were going to be stable there for a while, that would be fine. You know, over the last 5 or 6 years, we've been at 1.6 and 1.7 and been at a stable level. So that would be kind of the flip side of that. By contrast, if we were at 2.2 and then the next quarter we're at 2.4 and then we're at 2.6, that trajectory is the thing that would give me some concern. So for me, I'm going to be, certainly the level is going to be something to pay attention to, but for me, the trajectory is much more important.
Well, give me your levels. From the forecast that you made, where do you think growth and inflation and unemployment are going to be in 3 years?
Well, in 3 years, hopefully, we will have the pandemic past us. We will have sort of figured out what all the structural changes that have gone on mean, and the economy will be back on a robust path. So our long-term estimate for our models is around 2% growth. Inflation can go at above 2% as well. I actually think just before the crisis, we were heading in that direction. I was pretty optimistic about how things were going. And then in terms of unemployment, I think we can see levels approaching the 3.5 to 3 3/4 that we saw before. So I'm pretty bullish 3 or 4 years out, but we still have a lot of work to do right now to make sure that the amount of pain and damages that happens to this economy is minimized. So I think that staying on the local and the immediate term is something that we all should try to continue doing for a bit longer.
Well, I'm sure you know one of the criticisms on Wall Street after the meeting was that you can talk about getting over 2%, but you can't get to 2%. Why do you think that's going to happen?
Well, for me, I've been talking with my team a lot on this, and just before the crisis, and this is something that I tried to say in interviews, and I've talked to my colleagues about this, many of the signals of inflation were at 2%, if not above 2%. So I think we were actually much, much closer to our target just pre-crisis than I think has been really recognized in the press. That said, we are not in that place now. But I have confidence that once we get back into sort of stable growth and robust recovery, that we can get back to that pre-crisis level where all the signs were positive. So I think that we in the last few years have done a lot to get inflation to a place where I could be comfortable with it and would suggest that the economy is really moving in a sustained way.
Well, is your policy now inflationary in and of itself?
So that's an interesting question. I guess what I would say right now is the pandemic is something that we've never seen before. This is a historic type of event. And if you look at the inflation numbers, there's a lot of noise in there. So month to month and quarter to quarter, the elements of a CPI, for example, are showing wide swings and much wider swings than you would ordinarily see. So it's hard to know exactly what signal we're seeing right now. At the same time, how labor markets have evolved has been so dramatic, and the stresses that have happened to particular businesses and how the pandemic has hit certain sectors much differently than others, it really makes it hard to tell exactly what's happening in terms of inflation. It's something that we're going to continue to work on. I'm hopeful that as we get further along in the recovery, a lot of these signals will become clearer. A lot of the noise that's happening and the extreme values will be reduced and be eliminated, so we can really understand sort of where the economy is standing.
I'm wondering what more, if anything, you can do. Your tool is interest rates. You've got interest rates at zero. You have tools to push down interest rates, but is there anything more the Fed can do to stimulate the economy, or is it really over to Congress now?
Well, I would say Congress has a very significant role. Fiscal policy is going to be important because the types of things that can happen in fiscal policy are not things that we actually have authority to do. So grants have been very important to small businesses through things like the Paycheck Protection Program. Those sorts of things create much more stable bridges than the type of lending that we can do. What I am doing here at our bank is a couple of things. So first, really trying to monitor the economy, make sure we're talking to small businesses, to families, and to banking institutions, so we understand where things are working well and where things are not working well, and we can deliver that information to policymakers in Washington. A second thing that we're doing is we are trying to engage with communities across this country, giving them advice on things around economic development, around sustaining small businesses in times of crisis that we've learned over years and decades of research and engagement in that space. So while we don't have a lot of energy in terms of interest rates, there are lots of other ways that we can try to sustain things, and we're doing all of those things. Another thing I would say is we're also engaging with banking institutions, encouraging them to deploy their capital and also to find ways to provide relief for businesses and to families who are struggling with their cash flows as a result of the public health response to the crisis.
We're speaking with Dr. Raphael Bostic, the president of the Atlanta Federal Reserve Bank. If you were to talk to a member of Congress today, what would you say about the economy? Earlier this month, you saw definite signs of slowing. Do you still see that?
So we definitely see signs of slowing. You know, Mike, is interesting. For me, our team has been thinking about how do you characterize the economy today? And what we're actually seeing is something that's akin to a less than signal or symbol, where some parts of the economy, both in terms of geographies and sectors, are doing quite well and growing, and others are struggling or have struggled or are actually getting worse. And so one of the things that's been very interesting and a challenge for all of us is how do you take an aggregate number that is really an average of those two things and convert that into a discussion of the economy? What I would tell a policymaker is, look, there are lots of sectors where there's still a lot of pain and disruption that's going on. There are a lot of families who have a significant amount of uncertainty, and those things will wear on our psyche and our ability to grow. So I would encourage them to think about ways that they might provide support to help those who are in more precarious positions not have to struggle and worry. You know, we do an analysis of evictions, for example. We have an evictions monitor, and we've been working with Georgia Tech and some folks here in Atlanta. Eviction levels in Atlanta are higher now than they were a year ago, and the trend is going in the wrong direction. I've heard reports of this happening all over the place, which suggests that this precariousness is very present. And to the extent that that becomes a reality for a large number of people, the amount of pain we're going to have in the economy and the challenges we face to get to a full, robust recovery are just going to be much greater.
I don't know if you use WeChat or TikTok. I kind of hope we don't see you on TikTok, but
No.
Given that it's the news of today, let me ask you this: the policy, the trade tariff policy towards China, has that had a direct impact on your district?
So the tariff policy has impacted companies in a complex set of ways. So you know, some businesses in my district have direct and important business activities in China itself, and they're reporting significant difficulties. A lot of our agriculture sector exports to China and has relationships with them in that regard. And so it's been harder for them. And that adjustment is something that we're trying to, well, I'm trying to see how they're adjusting and what types of things they're going to do. But it definitely has taken a toll. But that said, the relationship with China is complex, and the trade issue has to be weighed against things like intellectual property and the protection of our comparative advantage. And so how this goes and how it plays out is important. Well, I would say I don't have a stake in this in terms of having authority to do things, but it is something that, as I see things happening, I try to make sure that policymakers in D.C. know, and I try to explain to our businesses and contacts across the district how this might look moving forward.
You've noted that the pandemic has had a disproportionate effect on low-income people and communities of color, and there's really no argument about that. But what can the Fed do about that?
Well, I get calls about this all the time, and our bank has been an important source of information for communities across the 6th District. And some of the things that we're doing are working with local government officials, trying to give them advice on ways that they might help their businesses. We've been talking a lot, actually, just about how you maintain business activities in the time of COVID. So how do you think about customer flows in and out of stores to engage with that? We've also tried to engage with philanthropy to tell them about the natures of stresses and suggest that there may be ways for them to have real significant impacts in the communities that they serve. And so we're actually going much more micro in terms of trying to help those communities because there are so many different contexts. I would also say this is not just a lower income and minority community issue. You go to a lot of the rural places, the more rural places of the district, they're struggling as well. They had challenges before, and as we've seen in many, many instances, this COVID crisis has exacerbated a lot of the disparities that we've seen. And so we're trying to work with rural areas as well to help them figure out solutions for this new world that we live in.
Joe Biden has suggested the Fed should act aggressively to combat racial inequality, even leaving open the possibility of adding a third mandate for the Fed. There's also talk that perhaps you should incorporate the black unemployment rate into your framework. What do you think of those ideas?
Well, they're interesting ideas. I think that we have to consider those sorts of things in a broader context. So for me, the black unemployment rate is one measure of how the economy is performing for an important segment of our population. But we have a Latino unemployment rate that is also higher than the national average and has been for a long time. You can think about labor force participation for women, for example. So this is a multidimensional issue, and I think that we got to think hard about how do we capture all those dimensions to figure out what's going on. I will tell you, though, I think that the policies coming out of the long-run framework are important because we are committing to letting the economy grow a little more robustly than we might have otherwise, and that has and should have positive implications for the ability of minorities and women and lower-income people to be fully attached to the economy.
One last question here. The Fed has suggested it is looking into its communication strategies. You struck all the language about the summary of economic projections from the new framework, and I'm wondering if we're going to see a different kind of communication arriving by the end of the year.
So I don't know about that. What I'm going to try to do is make sure that I continue to communicate as clearly as possible with my constituencies. I think we've done a pretty good job. And Mike, let me just say one other thing on that last question, which is, another thing that we're trying to do is engage communities and constituencies. Today, we're actually having a conference on racial justice and finance, where we're going to try to bring in different voices and have them grapple much more deeply with issues about race. We're going to continue to have those sorts of conversations moving forward. And I think we're going to try as much as possible, and I'm going to work to make sure that the Federal Reserve is a place that people look to for thoughtful solutions to issues around racial equity and disparities that we've seen historically.